All right, let's go ahead and do the second half of the chapter 4 video. Okay, so on this is a topic that used to be covered in the book, and now they moved it to the appendix of chapter 4, but I still really like it. So it's mainly covered in the notes and not necessarily in the book as much, but it is in a little bit, and it was in the previous edition of the book. And I just really like this topic, and I think it's important to acknowledge what an interim financial statement would look like. So if you're doing an interim balance sheet for the for a city, for a government, what you have to consider is that the encumbrances are still in there and the appropriations are still in there and the estimated revenue is still in there. So those things are still in there. So this is the accounting equation. We learned it in chapter, I don't know, maybe 2, but it could have been 3. I don't really remember. And then for fund balance, we decided there was reserved and unreserved. And then within unreserved, there were the budgetary accounts and the operating accounts. And so the ones that get closed eventually are going to be these. These are the accounts that will get closed. These are the temporary ones. And so they are still in process, though, during an interim financial statement. And so they still exist, and we don't close them during interim. So reporting. So we have to go ahead and figure out where to put them. And it feels weird, long balance sheet, especially revenues and expenditures. What we have these budgetary accounts that are like revenues we're still waiting on. And so what is revenue we're still waiting on? And revenue we're still waiting on is basically like a receivable. And so it actually goes on the asset section. And then appropriations is future spending that we haven't spent yet. So it's kind of like a liability, even though it's not a liability because we haven't actually incurred it yet, but we're going to incur it. So we have to figure out where to put it. And it's really weird, but I wanted you to see an example of it. So we're going to use an Excel spreadsheet, and I'm just going to show you what an interim balance sheet looks like. And so I'm going to take you through like the estimated budgetary resources, which is revenue we're still waiting on, and available appropriations, which is money that hasn't been expended or encumbered yet. So I have an example of it, and I'm just going to go work through it for you in the video. So let me find it. Interim balance sheet practice student. That looks good. Okay. So these are the balances. This is Ellis County. All right, named after Timmy Ellis, one of my former students. He was a friend of Jason Dunn for City of Dunn. And so what we have here is we have a bunch of account balances. Okay. So one of the things I'm going to do before I do this is I'm going to take that number and move it to this one. Just one second. Okay. All right. So balance and then okay. So when I look at this, basically, I know that when I make a balance sheet, these are assets. This is a contra. So a contra asset goes as a negative in the asset section. Another asset, another contra. Deferred revenue, deferred means later. So that's unearned revenue. So that's a liability. The asset, this is a liability. This is an asset. Due from federal government, we haven't done that yet, but we will shortly. Due from federal government is a debit because we're going to receive from the federal government. So this will be an asset. These are equity accounts. And so we don't call them equity in the government. We call them fund balance. Then we have revenues, expenditures, encumbrances, reserve for encumbrance, which is another equity account. And then we have our budgetary ones. And so what we have to figure out here is how to put them onto the balance sheet. So I set it up for you so we can actually see the way this looks. And you'll actually do one of these interim balance sheets in homework and in the project, have it set up for you there too. Okay. So the cash balance is 50,000, investments is 1,700. Property is receivable is 10,2, but we have an estimated uncollectible of 3. So the net of that is 7,200. Property taxes delinquent is 46,100, but we don't think we're going to collect 22,000 of it. Now that seems like a lot, but delinquent taxes are less likely to be collected. So that actually makes sense. If we had interest and penalties receivable, it would have an estimated uncollectible too. So we could have another set of those. Inventory of supplies is 50,000. Sales tax receivable is 9,500. Due from federal government is 50,000. So our total assets look like 348.3. Now this is where it gets weird. So this is called assets and resources. This is future money that we still expect to receive, okay? So our estimated revenue right now is 1,359,000. But of that 1,359,000, we've only got 1,336,000. 1,336,300. So what we're going to do is we're going to subtract that. So we are still going to basically ask for more revenue of 22.7. So if we do assets and resources, we have 371. So then I'm going to go ahead and hide this for a second so I can see the liabilities and equity section. So I'll bring it back in a minute. So for deferred revenue is sitting there at 31, and vouchers payable is sitting there at 190,700. So my total of my liabilities is 221,700. So this is that future spending I expect. So I have appropriations of 1,330,000, but I've already expended 1280,100, and I've already encumbered 38. So my future spending that I haven't done yet is 11,900. My reserve for encumbrances is 38. My reserve for inventory of supplies, and these are equity accounts. My fund balance unreserved is 49,400. I deleted this one. So my total equity, oh, am I bad at adding? 149,300 and 221,700, which is 371. So looking at this total interim balance sheet, it's different than a regular balance sheet because this is the asset section. So this whole section is assets. This section is liabilities. And this section is equity. So normally we just have assets, liabilities, and equity, but then we have these new ones. We have reserve, or we have resources, and then we have this available appropriations that is different. This is something that only the government would do because they do budgetary journal entries. So that's the difference on this interim balance sheet versus a regular balance sheet. So in your homework here, I don't think I make you do an interim balance sheet in your homework, only in your project. So let's pull up your project for a minute. And don't worry, there's going to be plenty of guidance on your project. I will talk about it many times. Let's go here. And so on the interim balance sheet, I have it all set up for you. And so I have all the words in for you, and you're just going to go ahead and City of Macon, like bacon, you're going to take the balances from the T accounts, and you're going to be like, all right, that's my balance in cash. Put it here, and so on. And then I tell you what you should balance at. So this is for your project, and it's for 50 points, 50. So 2,194,090 is what both of those numbers will be when you have it right. And then you'll move on to Part B, journal entries. So it should go well. I think it's going to go great. Okay, so back over to our notes. Let's move on to the next part, and it's revising the budget. So revising the budget happens from time to time where maybe partway through the year, we realize that we're going to get this extra grant. So we have this extra revenue coming in, and we want to add that to our budgeted revenue so we can go ahead and spend and receive it. Or maybe we come up with some big expenditure that needs to happen. So we're going to adjust our current expenditures to a new number and add some additional. So it might have happened, maybe there was an error, maybe there was something else that happened, right? Unforeseeable expenditures or extra revenue. When we record it, we just, if estimated revenue increases, then you debit estimated revenue. And if it decreases, vice versa. If appropriations are increased, so just remember estimated revenue has a debit balance, appropriations has a credit balance. And so if they go up or down, you just record that, no big deal. Encumbrances of a prior year. So sometimes businesses close, or not businesses, but governments close out their encumbrances. Sometimes they just let them carry forward. And so we won't really have to worry about this in your notes or your homework necessarily, but I'm going to walk through it just in case. And so accounting for encumbrances depends on how the particular state or government handles it. In some jurisdictions, appropriations don't expire at year end. At other ones, they do lapse and you have to re-encumber for it the next time. So most commonly appropriations lapse, but the government's still going to honor encumbrances for goods that are still on order. So the appropriations start over, but whatever you encumbered for last year, encumbered for, and you still pay it, because that makes sense. Like you're not going to just not pay your bills because it's the end of the year. So assume at the end of fiscal year 2007, a reserve for encumbrances was reported at 8,300. Early in the fiscal year 2008, the goods are received at an actual cost of 800. First, the encumbrance 2008 is reestablished. So in this example, encumbrances got closed at year end. So you have to reestablish them. So what you would do is you would reestablish the encumbrances by using encumbrances and reserve. But instead of reserve, we closed encumbrances to fund balance. And so we're just reversing that. And then the reserve is still open. The reserve is still there. So after the 8,300 has been reestablished, you're going to go ahead and spend 8,500. So you spent more than you planned. So we're first going to reverse our encumbrance. No big deal. Okay. And then we're going to go ahead and spend 8,500. And so do you have a question? Yeah. To the mall? Do there. You're not going to steal anything, right?
No.
You're going to go to Annie Ann's and eat a pretzel. Hey, do you promise me? Like, because I don't want anything shady to happen. Because we've got Blythe. Is your mama okay with it?
Yeah.
She's okay with you going. Will you text her and tell her you're doing that just to make sure she's okay with it?
Yeah.
Okay, just to be sure. Okay, if her mom says yes and grandma's okay with it, I'm fine with it. Okay, love you guys. Okay, so now we're going to go ahead and expend that money. So the expenditure happened from the previous year. We're going to do expenditures dash 2007 for 8,300, but expenditures dash 2008 for the other 200. So we're going to go ahead and pay both of those, and we're going to probably pay later just because that's what we do. Yeah, so vouchers payable. So it's just a little difference when we have an expenditure that carries over from the previous year, but it came in higher than we planned. So if it was the other way around, so note that the 200 excess was charged to the fiscal year 2008 appropriation, but what if it was the other way around? So when you reverse the encumbrance for 83, and then you'll just go ahead and spend 81. And so the extra 200 just didn't get expended because we had enough to cover it. All right, so next is accounting for inventory. And when we do inventory of supplies is what we're usually talking about. We have a consumption method and a purchases method. And so the consumption method is just like we do an accrual basis of accounting. So when we buy supplies, we record it as an asset. And then as we use it up, we move it to supplies expense. And so, and that's how we do the government-wide level, okay, and any proprietary funds. But the purchases method is consistent with the modified accrual basis because basically everything is an expenditure when you spend the money. And then at the end, you're going to say, well, how much money do I have on hand? How much supplies do I have on hand? And you'll adjust your inventory of supplies. So we're going to do the consumption method first. And so town of Dunn purchases 100,000 of supplies. So you would just put it in inventory of supplies. And I don't know if we paid cash or it'd be vouchers payable, but either way. And then assuming that 95,000 was consumed during the year, then you would move it from inventory of supplies to expenditures because you actually consumed it. So at the general fund level, we would move it to expenditures. And then at the government-wide level, we would do expenses dash general government or whatever it is. So now the balance in inventory of supplies is sitting there at 5, which is what you have left. But what's this? So since we now have a balance of 5, we need to, we have to fix our reserve for inventory of supplies. And you probably saw that in that Ellis example, and you're probably like, what is that? So what happens is inventory of supplies and reserve for inventory of supplies is always identical. So whatever you have in inventory of supplies is exactly what you have in reserve for inventory of supplies. So those will always match. And so in this case, we just adjusted our inventory of supplies. Oh, by the way, that says 100. It's supposed to be 95. I don't know what I was doing there. I just saw it. So looking at this, we had 100 in our inventory of supplies account, but then we reduced it by 95. So we also have to reserve for inventory of supplies. So what we'll actually do here is we will reduce that. And so I'm going to delete what's here because I like to do it with you. Oops. Bad at my job. There we go. Okay, so we need to fix the reserve for inventory of supplies because right now it doesn't have anything in it. So if we look at what's happened, inventory of supplies got debited by 100, but then it got credited for 95, but we never touched reserve for inventory of supplies for this particular transaction. So I have 5,000 left. And so inventory of supplies needs to match reserve for inventory of supplies. And so inventory of supplies is 5. And so our reserve account is a credit. Our reserve account is a credit. That's because it's a fund balance account. It's an equity account. So reserve for inventory of supplies. What a big account. It's 5,000. And then the other side of that, we are taking it, we're just reserving it out of the fund balance. So the unreserved, like fund balance dash undesignated unreserved is what they usually call it. That fund balance account needs reduced because we do have that supply of inventory on hand. And so these are both equity accounts. We are just making sure that reserve matches inventory of supplies. Okay, so this is another example that will be similar to what you guys will actually do during the homework and stuff. So assume at the beginning of the year, the inventory of supplies is 10, we purchase 150 and we use up 135. So I said, draw a T account. I love T accounts. So we're gonna start off with 10,000 and then we bought 150. We used up 135. So our balance is 160 minus 35 is 25,000, right? So our inventory of supplies account went from 10 to 25. So what we need to do is we need to get our reserve to do the same thing. So we need to adjust our reserve for inventory of supplies. So this is what you guys will do in the homework, okay? And so what we need to do is we need to make our reserve account go up by 15. It's full today. We need to make it go up by 15. And so we just take that out of fund balance. Okay, so this is us fixing our reserve account to match the inventory of supplies account. All right, now we get to move on to closing entries. So in financial accounting, when we do closing entries, we close the red ones. And so those of you that haven't had me in class, which I've only had 2 out of all of you guys. So most of you probably are like, what did she just say? And I said, we close the red ones. And so we close revenues, expenses, and dividends. They're the red ones. And those are the temporary accounts. Those are the ones that start over every year. So in financial accounting, we close revenue to retained earnings, expenses to retained earnings, and dividends to retained earnings. Revenue, R-E-D, revenues, expenses, dividends to retained earnings. So when we do that, we just move all of those temporary balances into a permanent account. We are going to do the exact same thing for the government, but are you okay? Okay. So we are going to just pause 1 second. Are you all right? No, I'm still recording. I just heard you make a funny sound and I want to make sure you're okay. Okay, sorry. Okay, so back here. So what we're going to do is we're going to close everything to a permanent account. That permanent account is going to be fund balance. Just like we close to retained earnings, we're going to close to fund balance. So you can do one giant journal entry to close all of these to fund balance. So you can get rid of estimated revenue, appropriations, encumbrances, revenues, and expenditures. 5 temporary ones. And we learned that when I was identifying if they were debit or credit balances, I think in chapter 3. So we're going to close estimated revenue, estimated OFS, appropriations, estimated OFU, revenues, expenditures, And then don't forget, we also have encumbrances because those are also temporary. So all of those accounts need closed. And so we won't have estimated OFS and estimated OFU all the time. Okay. So when we do this, we can do one giant journal entry to close them all. So any combination of entries that close all the temporary ones is acceptable. Your textbook closes them in steps, but if you prefer to just close them as one big giant entry, that's fine with me too. So you need to reverse the entry for the budget. So you need to get rid of estimated revenue, estimated OFS, appropriations, estimated OFU, and then encumbrances. And then you also need to close your operating accounts. So those would be your revenues and expenditures. And you could have other revenue and other expenditures. So, and we're going to close everything to fund balance. So using the Ellis County example, let's close. So what I want to do is I want to use that Ellis County example. All right, so asset, contra, liability, asset, equity. All right, so these are the ones I need to close. So come over here. Have any room anywhere to just put this somewhere? Maybe here. Aw, came in ugly. So I'm gonna try to fix this because it's gonna bother me if I don't. Maybe if I do this and I say this and I say auto fit contents. There we go. Ah, it's so much better. Okay, so I'm gonna close these. So I can do one giant journal entry and close the whole thing, or I can do them in the steps like the book does. I'm gonna demonstrate the book method. So I'm gonna actually do an entry 1, 1B, and 2. So in your homework, you'll see me do that there too. This one. Here, closing entries. And I'm gonna do 1A, 1B, and 2. And I said close budget, close encumbrances, close red, no dividends. Okay, so going back to this, these are my numbers from City of Ellis or whatever. So first I'm going to close my, oh, by the way, this is not a budgetary account. Okay, so we have, I'm going to delete that row. I had just copied and pasted that from the City of Ellis or whatever. So here are my temporary ones. I have revenues and expenditures. These are my budget, or these are my operating accounts. And then these are my budgetary accounts. So first I'm going to reverse my budget. And so estimated revenues is a debit. So to close it, let me go ahead and do this real quick. Okay, so the first thing I'm going to do is I'm going to close my budget. So to reverse entry to record the budget, estimated revenue is sitting there as a debit. So to close it, I need to credit it. Now, if I had estimated OFS, I would also credit it. So estimated revenue of $13.59. And then appropriations is sitting there right now as a credit. So to close it, I need to debit it. And the difference looks like 29,000 as a debit. And so we close to fund balance. Now, if in the budgetary entry you used budgetary fund balance, then you would need to close budgetary fund balance. And so whatever you used in your original budget, use the same account to close it. So I want to make sure I did that right. 1330 and 29. Yeah, 1359 and 1359. Okay, step 2, close encumbrances. And so encumbrances is sitting there at 38. It's a debit. So to close it, I'm going to credit encumbrances. And again, I close everything to fund balance. So encumbrances is 38. Oops, there we go, 38. And then I need to close my revenues and expenditures. I'm going to close my red ones. So revenues needs debited to get rid of it. And I need to credit expenditures. So expenditures is 1280, 100. And revenues is 1336.3. 1336.3. That's what I said, right? 1336.3. Okay. And the difference? I need a credit of 56.2. All right. So those entries then will zero out all of my temporary accounts. All of these accounts are now gone. The budgetary ones were estimated revenue and appropriations, and then encumbrances. And then over here, my revenues and expenditures. All those got zeroed out. We are not going to do the closing entries for the government-wide level because the government-wide level, we've got to get through all the other funds and stuff before we worry about closing them. So you only have to close the fund. So when you look at your homework and you do your closing entries, oh, by the way, look, I did this one for you. So, right. So, so here, after you close these entries or whatever, you do not have to close on this side. I do not make you close on that side because we're not done with all the other government-wide financial stuff. So we do not have to close the government-wide level. All right, back over here. Where do we leave off? We've done our closing. Okay, the other thing is this chapter doesn't just cover the general fund, it also covers special revenue funds. And so for special revenue funds, I'm not going to make you do a lot of homework based on that, but they're handled very, very similar to the general fund. The general fund is the main one I want to cover in this chapter, but we're going to look and see what it would look like for special revenue fund accounting as well. So accounting for an operating grant. So if we're going to get a grant, what happens? And so it says assume a grant of 100,000 is received at the beginning of the fiscal year from the federal government to operate a counseling program for troubled youths. Is that how you would you say youths with an S? Until the grant has been earned by meeting eligibility requirements, it's reported as deferred revenue, a liability. Remember, deferred means later, it means unearned. And so what we would do at the special revenue fund is we would show that we are receiving the money, but it's unearned. So cash and deferred revenue. If we look at the government-wide financials, it would be exactly the same because we have an asset and a liability. So I'm just going to make a note of that. Same at government-wide level. Okay, so for governmental activities, it would be exactly the same. So then it says, assume that during the year we expend 75,000. So you would get rid of unearned and move it to earned, and you went ahead and spent the money. So you expended it. So notice that my revenues and expenditures are identical. All right, so as far as required financial statements, and so that's really the only difference. Everything else is going to be reported just like you would at the government-wide level. You may have a separate column for it depending on if it's a major fund, and so you'd have that 5 and 10% rule to know if you have a separate column for it in your government-wide financials. But you would do fund financials for a special revenue fund along with the general fund and the capital projects funds and all of those. So the last topic that we talk about in this chapter is inter-fund activity. And this is when money transfers from one fund to another. So remember, the fund is a whole umbrella. And then from that, then we have individual funds underneath the umbrella. Well, what if the general fund gives money to a capital projects fund? The umbrella, nothing happens. So when you think about the umbrella, if money changes hands between the funds, like they didn't receive any money, they just gave money from one fund to another. So how do we account for that? So what we do is we use accounts called interfund loan receivable or interfund loan payable or interfund transfer in and interfund transfer out. So OFS, interfund transfer in, and anytime you find one of these in another fund, you'll have a transaction that says interfund transfer out. So anytime there's an in, there has to be an out somewhere else. So it looks like I didn't practice those entries. They will be in your book to practice those, but we will go ahead and practice those a little bit in the homework. And so these, we don't do any of these in this chapter, so we won't worry about any of that. So let's go over to your homework for a few minutes, and I want to look at some of those interfund transfers. So this is your project, but this is your homework. So I don't know if it's this one. Yeah. Okay. So I think on this problem, I'm going to actually work through part of it for you because I'm actually kind of curious here. So on problem 423, that's the one that you're going to deal with interfund transfers. And so on that one, it says like the fire department, a government-wide activity, purchases 100,000 of water from the water utility fund and enterprise fund. And so we're looking at how that would be in the city and how it would be at the government-wide and how it would be at the enterprise. I think I'm going to wait and I'm going to actually demonstrate this for you because I've been talking a long time. I need to take a little bit of a break. So I'm going to demonstrate it in the intro to the week video. So when you watch that, you'll see a little bit of this. And so I'll help you a little bit with your homework. So as far as homework goes, you have one that's just a quick question, which is doing the grossing up of this. There's some multiple choice questions. Problem 422 is one that deals with the subsidiaries in addition to doing both sides. So this one seems long, but it's really not because a lot of it's just detailing the subsidiary where you'll do like general government, public safety, public works. And then this compares budget versus actual on those different items. And so, so I'll help demonstrate that a little bit when we do our overall video too. 423 is the one I'm going to talk about a little more, but this is going to be a lot like the notes. So you're going to do 424 and then you're going to do the T accounts. There may be some beginning balances. And so looking at 424, there are beginning balances on page 164. So like cash starts at 97,000, taxes receivable current starts at 0, but taxes receivable delinquent starts at 583 and estimated uncollectibles is 189. Notice that I'm automatically putting in the balances for you. It's just a formula. And then down here, I'm making sure that debits and credits equal. So once you get all your beginning balances in, your debits and credits should equal. Oh, this is nothing because we haven't done, it's not estimated uncollectible taxes current with a balance, but allowance for uncollectible taxes delinquent is 189. Interest and penalties receivable is 26,280. 11,160. 16,1. Vouchers payable is 148.5. Due to federal government is 59,490. Due to state government is 16,100. No, due to state government's nothing because 16,1 matches the inventory of supplies. So that's this one. And then fund balance is 298,130. So after we enter those beginning balances, our debits and credits should equal at this, and it doesn't equal at exactly the 722,380, and I don't know why. That's weird. That's going to bother me. Oh, I think it's because these. Okay, that's just the debits. Okay, I'm fine with that. Credits. Why don't I have the inventory and supplies in there? It's weird. Okay. And inventory of supplies. So, all right, for some reason I had both of those debit and credit side excluded, but it should equal the 722,380. So I'll try to remember to go fix your homework. So, all right, guys. So that's it for now. And so this takes care of chapter 4's lecture. And I'll make a separate video that introduces the week that kind of talks through a little bit of the homework. And so we'll go from there. So I hope you guys are doing well, and I'll talk to you later. Thank you.